After the study of this lesson, the reader should be able to understand the meaning of returns and risk involved in the securities investment decision, analyze the impact of different types of risk on the investment decision, learn the different techniques available for measuring risk and returns, apply the CAPM model to calculate the relationship between expected returns and systematic risk with the help of beta coefficient. We shall commence this module by studying the concept of risk and return. Every financial decision has two aspects. These are risk and return, as these are the two main determinants of the security prices. They have their impact on the share prices as well as valuation of the firm. Every decision involves some degree of risk. So, an investor has to take his financial decision rationally to optimize his return through the calculations of risk and return. Now, first we will discuss about the concept of return. Return is associated with the gain or the loss on money invested in the market. The rate of return on the security is the annual income received plus any change in the market price of an asset. Return is required to maximize the market price of the share, but return is associated with the risk because the greater the return, the higher the expectation of risk. An investor has to consider the risk of the different financing patterns to balance his decision between risk and return. Like the return is expected to be high for investing in purchase for an equity share in the market, but such a return is associated with the high risk. Government securities have a low risk as they provide stable return but very low rate. Thus, the investor has to pay the price in terms of loss of return in order to invest the sale securities having minimum risk. Now, we will discuss the concept of risk. Since the investment decision is based upon the future estimate returns, which are exposed to different kind of risk, so forecast cannot be made with certainty. Thus, risk and returns are closely related. A profitable investment may also be very risky. So, an investor has to manage a trade-off between risk and return. The variability of the actual return from the expected returns associated with the given asset is defined as a risk. The greater variability is associated with the risky securities like equity shares, and the more certainty of the return associated with the government securities like treasury bills have lesser variability and thus are less risky. Risk on investment like bank deposits are considered to be quite safe, but rate of interest can change depending upon the policy of RBI. Investment in the equity securities of a firm possesses higher degree of risk as compared to the government securities and the bank deposits, as they are surrounded by the market risks, which is quite uncontrollable because they are broad spectrum depending upon the market forces. An investor has to take a decision in investing the firm's fund in such a way to optimize return along with the minimization of risk. This combination is called risk-return trade-off. This is the level where the market price of the share is maximized. The balance brought about by matching risk and return, helping in achieving the objectives of the wealth maximization. We will now move on to understand the types of risk. The investor tried to reduce risk by understanding the risk environment. Risk consists of two types of exposures, that is systematic and unsystematic exposure. Systematic risk. Systematic risk is due to the broad spectrum of uncontrollable risk associated with the business activities within the country. It generates out a macroeconomic environmental factors such as demand, supply, inflation, change in interest rate and change in the government policies backed by the sociological and political factors in the country. It is an uncontrollable risk as these forces are beyond the control of any individual and thus cannot be minimized by the single firm. They have their strong influence on the market conditions. Such risks are called market risk and interest risk and purchasing power risk. These risks affect the cash inflows of a project. The changes in the cash inflows will also bring about change in the profitability of an investment proposal. Unsystematic risk. Unsystematic risk is a unique risk related to the company pertaining to the behavior pattern and internal influence of the firm, like problem related to the management, staff, expenses, losses, strike and other issues directly affect the company's own operations. These are controllable risks and thus can be minimized by diversification of investment portfolio. Thus, an investor must analyze the existence of the degree of the above mentioned two risks to balance his decision of the risk and return to get potential gains at the minimum risk. Now, we will further discuss the measurement of risk and return. Return measurement. Securities provide returns in the form of dividend or interest, and it also provides a return at the time of sale in the form of capital gain. The securities have to be valued at different points of time. The returns at a particular point of time are required to be calculated by discounting the returns at an appropriate discount rate, which depends upon the individual's own perception of risk. The discount rate, which is also called the required rate of return, show the risk of the cash flows. It would also help to determine the value of asset. The higher the discount rate, greater will be the risk level. Thus, the value of an asset therefore varies according to the risk perception and estimation of each individual. The required rate of return can be calculated with the help of the following formula. K is equal to IR plus RP, where K is equal to required rate of return, IR is risk-free rate and RP is risk premium. The risk-free rate remains the same irrespective of any increase or decrease of risk level. The risk premium, which indicates the compensation for taking the risk, increases with the increase in risk and decreases with the decreasing risk. Thus, the required rate of return comprises of the risk-free rate, the risk perception and the risk premium. In the above figure, the x-axis shows the level of risk and the y-axis depicts the rate of return. From the point of the origin and up to the IR is the risk-free zone. The slope after the risk-free rate slope upwards, as this is risk premium for the compensating high risk with the high return. Risk measurement. The risk associated with the security from both of the behavioral and quantitative statistical point of view. Different techniques are available to measure these different risks. The behavioral view of risk can be measured by using sensitivity analysis and probability distribution. The statistical measure of the risk of a security are standard deviation and coefficient of risk. Sensitivity analysis. It is a behavioral approach to assess risk by taking into account a number of possible returns estimate so that a sense of variability among outcomes can be measured. In order to have a sense of variability among return estimates, A possible approach is to estimate the worst, pessimistic, the expected, most likely, and the best, optimistic return associated with the asset. The difference between optimistic and pessimistic outcomes is the range, which according to the sensitivity analysis is the basic measure of risk. The greater range indicates the more variability of the asset. Second, probability distribution. The risk associated with an asset can be assessed more accurately by the use of probability distribution than the sensitivity analysis. It is a model that relates probabilities to the associated outcomes. The probability of an outcome represents the likelihood or the percentage chance of its occurrence. For example, if the expectation is that a given outcome will occur 8 out of 10 times, it can be said to have 80% chance of occurrence. If it is certain to happen, the probability of happening is certain percent. An outcome which has probability of 0 indicates that this outcome will never occur. Based on the probabilities assigned to a rate of return, the expected value of the return can be computed, which is weighted average of all possible returns multiplied by their respective probabilities. Thus, probabilities of various outcomes are used as weights. The expected return RE is sum of RI into PRI, where RE is expected return, RI is the return of ith possible outcome, PRI is probability associated with the return, and N is number of outcomes considered. Standard deviation of return. Risk refers to the dispersion of returns around an expected value. The most common statistical measure of risk of an asset is the standard deviation from the mean or expected value of return. It represents the square root of the average squared deviation of the individual returns from the expected returns. Symbolically, the standard deviation is the square root of the expected return, rate of the ith possible outcome, PR, that is the probability associated with the return, and N is the number of outcome considered. The greater standard deviation of the returns indicate the greater variability or dispersion of the returns and the greater risk of the investment. It is absolute measure of dispersion and does not consider the variability of the return in relation to the expected value, coefficient of variation. It is measure of relative dispersion used in the comparing the risk of the asset with the differing expected returns. It is a measure of risk per unit of expected return. It converts standard deviation of the expected values into relative values to enable the comparison of the risk associated with the asset having different expected values. The coefficient of variation is computed by dividing the standard deviation for an asset by its expected value. CV is the standard deviation of R upon RE, where CV is coefficient of variation, standard deviation R is equal to standard deviation of return, RE is expected return. The larger CV is associated with the larger relative risk of the asset. The use of the coefficient of variation for comparing asset risk is the best since it considers the relative size expected value of the assets. Let us explain the measurement of the security risk and return through capital asset pricing model, that is CAPM. The capital asset pricing model is an equilibrium model of trade-off between expected security return and systematic risk, which is unavoidable. It is the basic theory that links together the risk and the return of the asset and also explain how the security prices are calculated in the marketplace. It provides the framework for determining equilibrium expected return for risky securities by deriving the relationship between expected return and the systematic risk of individual securities and portfolios. Thus, the CAPM has the implications for risk-return relationship for an efficient portfolio as well as for the individual security, identification of under and overvalued asset traded in the market, pricing of asset not yet traded in the market, effect of the leverage on the cost of equity, rate of return required by the equity shareholder, capital budgeting decision and cost of capital, risk of the firm through diversification of the project portfolio, assumptions. The CAPM makes certain simplifying assumptions to remove the complexity of the model. Some of them may be relaxed later. All investors are price takers. They are large in number so that no single investor can affect prices. All investors use mean variance portfolio selection model of Markowitz assets pricing model. Assets or securities are perfectly divisible. All investors plan for one identical holding period. Investors can lend or borrow at an identical risk-free rate. There are no transaction costs and income taxes. The market price of the share is influenced by the systematic and unsystematic risk. The CAPM approach measures the systematic risk of the security. Such a risk is measured by the beta, which measures change in the market value of the equity share relative to the change in the market index. If beta is high, the company's share will have high risk. The CAPM model calculates cost of equity through the following equation. KE is equal to KR plus beta KM minus KR, where KE is the cost of equity capital, KR is a cost of risk-free asset, beta is coefficient of the systematic risk, and Km is the cost of the market portfolio. Let us now discuss the elements of the model. The CAPM consists of two elements, the capital market line and the security market line. The capital market line, CML, it represents the risk-return relationship for efficient portfolios. It represents the efficient frontier formed by combining 1 month's T-bills with the broad index of the common stocks. It depicts the risk-return relationship for efficient portfolio available to the investors. It also shows that appropriate measures of risk for an efficient portfolio is the standard deviation of the return on the portfolio. The security market line, SML, it is a graphic depiction of CAPM and describes the relationship between expected return and systematic risk in the capital market. The risk-averse investors seek risk premium to assume risk embedded in the risky assets. Systematic risk, which is unavoidable, is the contribution of an individual asset to the risk of the market portfolio. According to the capital market theory, the market compensates or reward for systematic risk only as the unsystematic risk can be eliminated by diversification. The level of systematic risk is an asset is measured by beta coefficient beta. The CAPM links beta to the level of required return. SML is the linear relationship defined by the equation. Expected return, ER, is equal to the risk-free return, RR, plus beta into the risk premium of the market, where ERI, expected or required rate of return of an asset I. RF is risk-free rate of return, vertical axis intercept. Beta is the systematic risk of the asset. E RM is expected return on the market portfolio. E, RM minus RF is risk premium of the market. Then is the diagram which shows the security market line, where I is equal to intercept plus beta into slope of the SML. The more familiar form of SML is ERI minus RF is equal to beta into ERM minus RF. Risk premium on the security I is equal to beta into the risk premium of the market. Let us now understand the risk-return relationship. In the CAPM, the expected return on the asset varies directly with its systematic risk and the risk premium of the market portfolio, which is a reward depending on the level of the risk-free return and the return on the market portfolio. In other words, the risk premium for an asset or portfolio is the function of beta. That is, the risk premium added to the risk-free rate is directly proportional to the beta. Thus, the three basic elements required to apply CAPM model are risk-free rate, risk premium on the market portfolio and beta. Risk-free rate. The rate of return available on the assets like the treasury bills, money market funds or bank deposits is taken as the proxy of the risk-free rate, as such assets have very low or virtually negligible default risk and interest rate risk. However, under inflationary conditions, they are the risk less in the nominal terms only. In fact, real return, nominal retained inflation rate may become zero, even negative when the inflation wakes up. Risk premium on the market portfolio. The risk premium on the market portfolio is the difference between the expected return on the market portfolio and the risk-free rate of return. The CAPM holds that in equilibrium, the market portfolio is the unanimously desirable risky portfolio. It contains all securities in the proportion to their market value. In the efficient portfolio, which enables neither lending or borrowing, the risk premium on the market portfolio is proportional to the risk and the degree of the risk aversion of the average investor. Beta. Beta measures the risk, volatility of an individual security relative to the market portfolio. Accordingly, beta is covariance of the security's return with the market portfolio's return divided by the variance of the market portfolio. The covariance of the two securities is the product of their correlation coefficient and respective standard deviation. The covariance of the market portfolio with itself is the variance of the portfolio. Thus, the beta of the market portfolio is 1. This classifies all other market portfolios and securities in the two risky classes. Securities with the beta less than 1 are called defensive securities. Security with the beta greater than 1 is called aggressive security. Risk-free security has the beta equal to 0. Now finally, we will discuss the validity of CAPM. The CAPM is rigorously derived equilibrium model. It has been widely used on the basis of 4 factors. First, the risk-return trade-off, the direct proportional relationship between two, has a distinct intuitive appeal. Second, the transition from the capital market line to the security market line shows the undiversifiable nature of the systematic risk makes it relevant risk for pricing of the securities and portfolios. Third, the beta, the measure of the systematic risk, is easy to compute and use. Finally, the model shows that the investors are content to put their money in the limited number of portfolios namely a risk-free asset like treasury bills and a risky asset like a market index fund. However, the CAPM is essentially a single factor model in that securities' expected return depends upon a single factor, namely beta. But there may be other factors apart from the beta which may affect the required returns. Therefore, the inclusion factors like taxes, inflation, liquidity, market capitalization size and price earning in the CAPM equation would provide better explanation of the variables impacting securities returns which have been used in the extended CAPM model to overcome the shortcomings of the CAPM model. We shall now recapitulate what we have learned so far. Return is associated with the gain or loss on the money invested in the market. The rate of return on the security is annual income received plus any change in the market price of an asset. Thus, risk and returns are closely related. A profitable investment may also be very risky. So, an investor has to manage a trade-off between risk and return. The variability of actual return from the expected returns associated with the given asset is defined as a risk. Systematic risk is due to the broad spectrum of uncontrollable risk associated with the business activity within the country. It generates out the macroeconomic environmental factors such as demand, supply, inflation, change in interest rate and change in government policy backed up by the sociological and political factor in the country. Unsystematic risk is a unique risk related to the company pertaining to the behavioral pattern of the internal influence of a firm, like the problems related to the management, staff, expenses, losses, strike, and the other issues directly affect the company's own operations. The risk associated with the security from both a behavioral and a quantitative or statistical point of view. Different techniques are available to measure these different risks. The behavioral view of the risk can be measured by using sensitivity analysis and probability distribution. In the CAPM, the expected return on an asset varies directly with its systematic risk and risk premium of market portfolio, which is a reward depending on the level of risk-free return and return on the market portfolio.